As housing prices have surged and interest rates have climbed, many Americans are growing increasingly concerned about a potential housing bubble. The memory of the 2006 crash still lingers, particularly for those who witnessed property values plummet up to 50% in numerous regions across the country. That devastating collapse wiped out years of accumulated wealth for countless homeowners as their primary means of building net worth vanished almost overnight. And today, many are worried about a repeat. Following nearly 6 years of unprecedented growth, housing prices have soared beyond what many consider normal or sustainable. While various predictions about the market's future exist, few are as straightforward and bearish as those of Harry Dent Jr. This author, economist, and Harvard Business School graduate has presented a stark forecast saying that home prices could plummet by 50 to 80% in the next crash. One he believes is imminent. While these predictions may sound extreme at first glance, it's crucial to examine the reasoning behind Dent's argument. To gain a better understanding of his perspective, let's turn our attention to a recent interview where he elaborates on his forecast. The following is a clip from a conversation Harry Dent Jr. had with Sachs Realty on their YouTube channel. As we listen, pay close attention to the factors he cites and the logic behind his dramatic projections.
And again, I am saying that when real estate crashes this time more than last time, only back to 2012 lows, which doesn't sound that much, but it is 60% now for the average house, 70, 80% for the typical upscale house. We will never see real estate prices at those highs in any of our lifetimes, and probably not even our kids.
Wow.
Stocks in some places will. I don't think our stock market will ever see these highs either. I don't think the Dow will ever see 40,000 in any of our lifetimes again. But real estate definitely.
Yeah, let's dive into some of the reasons. But first, I want to talk about, and you mentioned Japan. Doesn't Japan have like 100-year mortgage or something crazy?
Yeah, they go out to 40 and 60, and I think they do have some 100-year mortgage. And that's what people do to stretch it and all. But again, Japan, people would say, well, when house prices go down, well, no, Japan will never, ever be the same, because unlike the United, we have the option, we have high immigration, and we'd have the option, since we're the most attractive country still in the world, to up it if we really wanted to ask for it, okay? Japan has aging demographics and no immigration. They've never allowed much immigration, and their culture doesn't want immigration. I don't blame them for that. They have a great culture, but they are a dying. Japan is the example to the rest of the developed world of how the entire developed world is plateauing or dying, in only a few countries like Australia, New Zealand, and Norway, Sweden, and Finland. 5 small developed countries in the world have demographics that go higher in the future. All the rest of them are flat to down forever, as far as you can see. Yeah. This is a first in the world. Economists don't understand this because they think it's all politics. All they study is politics and politicians and what they're doing and this bill and that. I don't study. You know how much time I spend studying politics? None.
There is no doubt that the US housing market is currently experiencing something unprecedented in recent history. From an affordability perspective, the situation is dire. Historically speaking, the thought process is straightforward. Relative to income levels, there has never been a time in US history where buying a house has been this expensive. Based on historical patterns, the expectation is that prices will eventually revert to long-term trends. According to Nick Gorelli of Reventure Consulting, inflation-adjusted home prices today are almost 100% higher than the long-term 130-year average. He accurately points out that throughout US history, home prices have closely tracked inflation, essentially following it. From 1890 to 2000, home prices consistently mirrored inflation levels and never entered a national bubble. This trend has only deviated twice in US history, in 2006 and right now. For many people, this situation seems unsustainable. For the housing market to return to any sense of normalcy, either inflation needs to skyrocket or home prices need to crash. Now, one could argue that inflation might indeed rise again, but in that scenario, the Federal Reserve would have to likely raise interest rates further. This action would have the unfortunate consequence of making housing affordability even worse. The actual remedy for the current housing affordability crises, apart from declining prices, would be rising incomes. An increase in wages would help alleviate the current situation in a way that potentially prevents an outright home price crash. However, there's a significant problem. Income growth is rapidly decelerating. This slowdown in income growth presents a significant threat to the stability of the housing market. Without meaningful wage increases that keep pace or exceed the rise in housing costs, the affordability gap will continue to widen. The outcome seems clear. We either witness a dramatic shift in affordability measures or face a potential housing market crash. It's tempting to disregard a century of reliable data and claim that this time is different. Moving forward, some may argue that this level of affordability will become the new norm, forcing people to allocate a larger portion of their income to home ownership. However, it's crucial to recognize that this market is largely sustained by what I call the post-2008 miracle boom. For much of the population, especially those voicing their concerns online, few have truly experienced a significant recession. One could argue that aside from the brief unemployment spike in 2020, this country hasn't faced a real recession in recent history. While the market has endured temporary setbacks and challenging years, the average person has not felt the profound economic distress that a true recession brings. The crux of this lies in employment. Outside of personal issues, the most impactful economic factor in people's lives is job loss, followed by a weak job market. For those who lived through the 2008 recession, the severity of such times is all too familiar. It's easy to look up the unemployment rate, which peaked at 10% in October 2009, and underestimate the true horror of recessions. This statistic doesn't reflect the reduced hours, wage cuts, and the widespread issues that a major recession can trigger across the country. Everything from mental health to stress, consumer spending, and innovation is affected by such events, and these impacts aren't fully captured by the numbers. If we were to enter a recession of this magnitude, something we haven't seen in over 15 years, the already inflated housing market would be at serious risk of collapse. People are already struggling to afford homes in this overheated economy. Now imagine the drop in demand if the situation were to implode from here. To understand the potential severity of economic downturns, look no further than Japan. Japan is a modern, innovative society with over 125 million people, and while it may not match the economic might of the United States, it's a respectable player on the global economic stage. In 1989, Japan was in the midst of what is widely considered the largest asset bubble in history. Their equivalent of the S&P 500, the N225, soared to an astonishing 39,000. To put this into perspective, from 1970 to 1989, Japanese large-cap companies delivered annual returns of over 22%. While small caps surged closer to 30% annually for 2 decades straight. It was a period of pure euphoria, with the exuberance spilling over into the real estate market as well. Between 1956 and 1986, land prices in Japan skyrocketed by 5,000%. Even though consumer prices only doubled during that time. At one point, the Japanese real estate market was valued at 4 times that of the United States, despite Japan being 25 times smaller in landmass and having 200 million fewer people. It was the bubble of all bubbles, and then came 1990. The Nikkei 225 plummeted by over 80%. In fact, the index wouldn't recover its 1989 high until February 2024, an astonishing 34 years of stock market stagnation. For some, this represents an entire working lifetime without ever seeing new highs. When adjusting for inflation, the Nikkei is still significantly below those previous peaks. A chart from the St. Louis Fed shows the inflation-adjusted index still has a long way to go before it ever reaches those top levels again. The real estate market in Japan tells a similar story. The typical Japanese home lost 47% of its value between 1991 and 2009, and even now, 34 years later, it has yet to recover. This isn't even accounting for inflation. A Japanese residence is now priced at the same level as it was in 1987, illustrating just how devastating a collapse can be in a modern economy. Now, of course, Japan doesn't have the advantage of having the global reserve currency or being the economic and military superpower, but regardless, it's a glimpse into what is possible in bubbles. Today, housing is at its most unaffordable levels in a long time, and to end this video, I will say that if you're out here searching for a deal as an investor, look no further than Foreclosure.com. Foreclosure.com stands as the premier resource for distressed home sales in the United States, offering a vast repository of over 1.8 million listings. encompassing foreclosures, pre-foreclosures, bankruptcies, tax liens, and other distressed assets. If you're looking for a deal as a professional, please give this amazing website a chance. You can get a free week by using my affiliate code found in the description. And while you're at it, don't forget to check out my brand new Substack, which contains articles that go along with these videos with more technical details and charts. That link is also in the description. And finally, don't forget to hit that like and subscribe button if you enjoyed it.